Hi, this is Danny Beit-Or from Simply Do It, and I want to talk just for a few minutes about private lending and what private lending is all about. Just as a quick disclaimer, I want to make sure you understand this short presentation, is for an educational purposes, and it's not an investment advice or how you should be going about private lending, or should you consider private lending altogether. I'm also going to say that we at Simply Do It, we don't facilitate private loans and we don't deal with private loans as a business, but we do incorporate private loans to our ongoing transactions. So what is private lending? Simply put, you become the bank. That's it. Like all the banks that you know, national, local banks, that they provide mortgages and loans to buy real estate, they are the lender. When we come and we talk about you providing a loan as an investor, or providing a loan as a source to an investor to buy real estate, technically you're becoming the bank. So the only difference is, as a private person yourself lends money to conduct a real estate transaction. Very, very similar to how banks are conducting a transaction like this one, but instead of going to the bank, we're going to a private person. And just so you know, generally speaking, like the bank, your funds are secured by the property. And we're going to get around, to. Generally speaking, we're not going to go to every type of investor, but generally speaking, we categorize investors into two groups: the active one, that are more involved with the ongoing operations of the property or the investment, and a passive one, someone who's a little bit more or less involved in the day-to-day, and someone who likes to be a little bit more passive about their investment. When you talk about active, you're probably going to see house flippers, someone who buys rental property, and so on. And you talk about passive, you got private lender, like we're talking about, someone who invests in a REIT. If you are someone who invests in stocks or bonds or paper, other type of paper, you're going to be more of a passive investor. That means you're not influencing the deal, or not doing any type of ongoing work on the, on the transaction itself. Requalify borrowers all over again, and then even when they qualify a borrower and a property, they lack the consistency of seeing more transaction on an ongoing basis. As a private lender, there are mainly two ways you're going to be making money on the loan. One is you collect some upfront fee, typically called points, and the second thing is going to be the monthly interest payments, exactly like the bank. So let's take an example. Let's say here we have a house. The purchase price is $100,000. The renovation cost is $50,000, and once completed, we're going to sell it for $170,000. So let's see, the ARV, the after repair value, is 170. So let's see how this property will look like, or the numbers will look like when we do, we do it with the private. From the top, we're selling it at 170, and of course I'm talking about once the deal is over and the renovation is completed, and we have a buyer, and here's how the numbers would look like, generally speaking. So we sell it for 170. And we have selling expenses that are commission and maybe some other selling expenses. Then we have a private loan. Let's assume we took a 70% loan of $105,000. And we got the loan cost, points and interest, $6,300. And the buyer had put down a down payment of $31,500. So that means if we take 170, we deduct all the expenses, selling expenses, the loan amount, the loan cost and interest, and the buyer's down payment, the buyer just made a profit of $13,600. Okay, so think about it as a buyer, you're looking at $13,600 profit over a $31,500 investment. When you are buying, when you provide a private loan, there's several tools or several items that will help make sure your investment is secure. First one is an insurance policy, a regular insurance policy on the property. Then we're going to do we're going to make sure we're buying the property with the title, search and the title insurance. Then there is a promissory note. The promissory note is the terms of the loan and that are being recorded to the property in the form of a lien. So it's a public record. And then we have the mortgage agreement, what specifies all the terms of the of the mortgage terms, of course. Let's see, as a private lender, as a passive investor, we should say, what are your alternatives? You can go and put your money in a saving account and maybe get 1.25% annually. You can put in CDs and improve that to maybe 1.3%. Fixed rate bonds will give you 2%. Stocks, hard to say, we just assume 6%, but maybe you can do even higher than that or lower than that, so it's really unpredictable. But let's just use 6% as a benchmark. As a private loan, you're going to do 8 to 10%, and I'm talking about obviously annual interest. And remember, as a private loan or when you do a private loan, you get points plus an interest. The monthly interest payment or the annual interest on your loan. If you do rental properties, you're probably looking at 20 to 25% return on investment, not rate, but return on investment. And you flip a property, you're probably looking at the 30% return on your investment. So those are different mechanisms you can invest your money. I'm sure there are more. I just wanted to provide you with some benchmark options. So if you are someone who's considering how to invest in real estate and not sure how to go about it, this is a couple things that private lending could be beneficial for you. First of all, you're passive. So that means someone else is doing all the heavy lifting, someone else is doing all the work, plus taking all the risk. The gain and the risk. You can use resources that are not always available to you to do other things. For example, let's say you have a self-directed IRA and you want to put it into a more conservative but better than savings and CDs and stock type of an investment. You can do it with your IRA or self-directed retirement account. If you have a HELOC and your HELOC can provide you with access to short-term funds and you're not really tapping into it, you can say, I'll pull some of my HELOC stands for home line of credit. You can tap into that resource and use it as a resource. So think about it for a second. Let's say for a moment you have a HELOC. Let's say you have a HELOC of $100,000, or let's just say you have a HELOC of $200,000, and you want to pull $100,000 out. You're going to probably pay 3.5–4% or so on those funds, and you're gonna give a private loan to someone else that, let's say, even does 8% or 9% on your money. So that means you got a spread of 4 or 5% on your money. And by the way, remember, this is not money that was available to you earlier, so it's not even your money. So your returns on the HELOC are going to be infinite because you're paying 3–4% on the money on one hand, which is funds that are inside your house, in the walls technically, and you're not doing anything with them. And you're borrowing it, let's say 3.5%, and you're lending it at 8.5%. Let's just take a number in the middle, and you have a spread of 5% on the money that was not accessible to you. So this is pretty awesome. You may have a stock portfolio that you're thinking of liquidating, or you're not sure if you should liquidate. You can take part of it and liquidate and put it into more work as a private lender. And typically we see that a private loan lasts anywhere from 4 to 12 months. So it really depends on the deal, of course, but this is what we typically see, that the private loan will be anywhere from 4 to 12 months. So that means it's a shorter term investment for someone who wants to consider it. And by the way, if the transaction takes longer, that means more interest payment to you. So that means the longer it takes, you still collect your money. Your money is secure with the interest payment, and it's actually a benefit from you, not a risk. So the risk will be, if the transaction takes longer, on the investor owner, that any month that takes longer to complete the deal, that means more interest payments, that means lower profit or maybe even a loss. So as we talked earlier, private lenders typically are concerned about who's the borrower and what's their experience. They need to validate the deal. They need to validate the team, the people that are doing the heavy lifting. And they lack the deal flow consistency. So this is, when we talk to private lenders, that's what they're telling us, that is really annoying to them. And they're always looking for, to mitigate all those 4 points, because that just create more headache, noise, and more work and more time spent to qualify all those the first three, and find a source that will create a consistent deal flow. Now, if you're a private lender and you have funds and you want to find borrowers, you can network, go to a networking meeting, present yourself as a private lender, and meet other people and start the process with them. You can go to online groups and forums and present yourself again as a private lender and do all that work. Talk to friends, family that are doing deals and are looking for someone to fund them. That would be another option. And you can work with us. We don't do all the other 3. We're actually looking for a few people that are interested in being the private lender and to help us fund our ongoing flips. And we do quite a lot. So we're looking for investors who are interested in providing us funds for private loans for our flips, which is hopefully you. Plus, you're gonna have the deal flow. You're not gonna need to validate the team and the investor. What you probably want to do is just to make sure you validate the deal. That's entirely up to you. We already validate the deal before we go into it, because we want to make money. And if you're if you're going to validate the deal, I think it's just another checks and balances in the process of someone else is validating the deal. Our typical loan on a flip is $75,000 to $150,000. That's the loan amount, which, as you can assume, our typical deal is the all-in purchase plus rehab is somewhere between $100,000 to $200,000. That's typically what we buy, purchase plus rehab plus all the relevant costs. So if you're an investor and you're actually thinking more of rentals or flips property, yes, you can definitely work with us. We have no problem with it. We work with a lot of investors. This presentation is more to educate us about private lending, but if you are someone who wants to be not a private lender but an active investor who buy rentals and flips with us, by all means get in touch with us. A private loan and take more of a passive approach, then do let us know as well. Here is our contact info. You can email us at meet, MEET, at simplydoit.net. Meet at simplydoit.net. We've also placed some additional resources so you can see different items that we put, like properties and flips that we've done. With that said, do let us know if you're interested. We will be happy to work with you. Thank you very much.